The one thing that I like to teach my clients is the difference between the psychology of being an investor rather than a saver. And I would like to demonstrate and ask the question, first of all, how do the banks make their money, and how do they create wealth for themselves? So that leads me into a demonstration by drawing a little picture on the board as to how the bank actually does maneuver that into a huge amount of wealth for itself. So I'll begin by doing a little diagram that we describe as the bank. And the bank usually has pillars outside to demonstrate its security and its ability to be trusted by the people that put their money in there. And we'll call it just a generic name of bank because they all behave much in the same way. So in Canada, we trust our banks implicitly, and we have probably the richest 5 banks in the world. Now, one of the ways that they generate revenue or growth for themselves is by creating a spread on the money, between the difference between them being investors and the difference between us being savers. So I'd like to demonstrate how that actually works. When we're savers, we are actually depositors, and we actually are earning interest or lending our money to the bank. So we become not only savers, but we become loaners. So on this side of the line, we are loaners to the bank. They guarantee for that loan, they guarantee us a set amount of interest or a fixed term of deposit. And that fixed term generates between 1% and 3% on our savings. Depends on the length of time that you actually lock it in and give it to them to be able to use. So on the other side of this equation, the bank obviously puts this money out and lends it back to us in different ways. One of the ways that it lends it back to us is on homes that give the bank full security, because they will not lend 100% of that home. In fact, they will only lend 75% of that home based on its value. And for that, they get a secured, right now at prime, they get a secured 6% return on that capital. Now, this little maneuver creates a lot of wealth for the bank because it likes to talk in terms of spread. And what is the spread between the 1% that they borrow and the 6% that they generate on the other side of that? Remember, this is a loan to the bank. It's fully taxed for the people that are the depositors. The 3% is a locked-in, usually a GIC, which means a guaranteed investment certificate, which allows the bank to control the money for as long as 5 years at a time without you being able to ever to be able to draw it back out again. So 1%, when we do the 1% spread, as the bank calls it, they call it a spread. It's actually, I call it leveraging the loaner's money and getting a guaranteed or non-risk 6%. So when we look at the spread on 1% to 6%, we are getting the bank is generating for themselves a 250% return. How do we do that? Well, we take most people that I talk to will say, well, the difference between 1% and 6%, that's 5%. But let's do it on a leverage basis, which gives it exponentially larger results. So when we take it from 1% to 2% on this curve, we get 100%. That's a double for the bank. So if they borrow it from us at 1% and get 2% coming out, that's a double for the bank. It's a 100% return for the bank. When we take it from 2% to 4%, that's another 100% for the bank, because they call it a spread or leverage. When we take it from 4 to 6%, that's another 50%. not quite a double. It's another 50% for the bank. So the bank is actually generating for itself a 250% return just on that one little spread maneuver. Now when we take the lendings out to include car loans and other chattel security, then it goes to 8%. And the big ticket, where they really get the big spread, is on the 19% credit cards. At one time, if you were a lender and you extorted 19% from your customer, you would have been considered, it would have been a criminal activity. Now it's quite legitimate. So 19% is generated on a lot of plastic credit cards today, especially unsecured credit. So can you imagine the spread between 1% and 19% is just right over the top. So how do we get in on this action? Well, we start to think like them, and we start to, instead of lending our money to the bank, we start to think in terms of owning the bank. On this side, we can be an owner. Instead of being a loaner to the bank, we can actually be an owner and own shares of banks and other financial institutions, wealth management institutions. That's how some of our managers have gotten the type of returns that they have gotten over time, is by owning a wonderful business called a bank. Because a bank is really just a business. It's the only difference between this business and others is that this absolutely does not produce any widgets at all. All it does is it basically just flows money through it, and a lot of that money sticks on its balance sheet. So now here we become an owner, and that's how we can, over time, by being an owner, generate a 15% return in a well-managed account that is capital growth and is virtually tax-free.